Welcome to Iron Financial. Our mission, as always, is simple: to help you forge a stronger portfolio. We do that by stress testing the market-moving events everyone's talking about. We cut through all the noise, we hammer away at the data, and we find out what's really holding up the market. Today, we are putting Applied Materials directly under the microscope. So let's get to work. Right out of the gate, let's talk about why we're even here today. Applied Materials, ticker AMAT, just dropped its Q1 2026 earnings, and the stock, well, it didn't just climb, it absolutely exploded. We are talking about a nearly 10% surge in one single session. Now, to put that into perspective for you, that's a jaw-dropping $23.5 billion in market value added in just a few hours. This is exactly the kind of move that can make or break a portfolio. Okay, hold on. Let me just get this straight. The stock adds over $20 billion in value, but when you look at the top line number, their revenue, it actually fell 2% compared to last year. So they are literally making less money than they were a year ago, but the stock is screaming higher? I'm sorry, that just doesn't add up. This is exactly the kind of thing we're here to figure out. Is this a truly solid foundation being laid for the future, or is Wall Street just building a complete house of cards on nothing but pure hype? That is an excellent question, and it's the core tension we need to resolve today. To do that, we need a plan. So here's our blueprint for this analysis. First, we're going to tackle that paradox you just pointed out, because understanding the market psychology is always step one. Then we'll decode the headline beats to see if the numbers really back up the hype. After that, we are going deep inside the machine, into the engine room, to find out where the real growth is coming from. We'll solve the profitability puzzle because, let's face it, not all earnings are created equal. And finally, we'll look at how they're forging the future with their guidance before we deliver the official Iron Financial verdict. We are going to tear this report down piece by piece and see if it is truly built to last. All right, let's dive into phase one, the post-earnings paradox. Look, understanding the psychology of the market is just as critical as understanding a balance sheet. That initial explosive reaction from traders tells a story, and our job right now is to crack that code and figure out exactly what that story is. So, here's the crucial point you have to understand. Your observation that revenue fell year over year, it's correct, but it's only half the story. Wall Street is a forward-looking machine. It never, ever prices a stock based on what a company did last year. It prices a stock based on what it did versus what everyone thought it was going to do. You know, think of it like betting on a horse race. You're not just betting on how it did in its last race. You're betting on how it's going to perform in the next race against all the odds and expectations. This whole game is about one thing: expectations. A beat just means they did better than the consensus estimate, and a miss means they did worse. That simple dynamic is the key to unlocking this whole thing. Okay, enough with the theory. Let's get to the hard numbers. You're telling me this is all about beating what was expected. So, lay it out for me. What was Wall Street actually expecting from AMAT, and what did the company really deliver? Let's put the reported numbers right up against this so-called reality of the analyst consensus. And here it is. This is where the rubber meets the road. Looking at this table, you can see exactly why the market got so excited. On the top line, revenue, the analyst consensus was calling for about $6.87 billion. Applied Materials came in at $7.01 billion. That's a beat of about $140 million. Now, that might not sound like a huge number for a company this big, but believe me, in the semiconductor world where every single basis point is scrutinized, that's a very significant signal. Then look at the bottom line, the earnings per share, or EPS. The street was looking for $2.20. AMAT delivered $2.38. That is a solid, undeniable beat of 18 cents per share. So yeah, while the year-over-year number was down, the performance versus what the market was bracing for was strong. This is the first major structural support beam we've found for that 10% stock surge. But a headline beat, it's just not enough. To really stress test this company, we can't just admire the finished building. We have to go inspect the engine room. We've got to get under the hood and look at the core business segments. Where's the real power actually coming from? And more importantly, are there any hidden weaknesses? Let's see how this machine is really put together. So the primary engine for Applied Materials is its Semiconductor Systems group. This is the heavy lifter. This is the part of the business that builds the essential picks and shovels of the entire AI revolution. Without their ridiculously complex machines, companies like NVIDIA, Intel, they simply can't produce their chips. In the first quarter, this division brought in $5.14 billion in revenue. Now, it's important to note that number is down from $5.6 billion in the same quarter last year. So on the surface, this main engine does look a little bit weaker. But this is where it gets really interesting. When you dig into the composition of that revenue, a new story emerges. As you can see right here on this chart, the biggest piece, foundry and logic, it actually saw its slice of the pie shrink from 69% down to 62% year over year. But look at that DRAM segment. That slice has grown significantly, jumping all the way from 27% last year to 34% this year. Folks, that is the AI effect in action. DRAM is the memory that is absolutely essential for AI servers and high-performance computing. In fact, the company said this was a record quarter for DRAM revenue. This isn't just some small shift. It's a powerful signal that the AI megatrend is directly fueling a high-growth area of their core business. Okay, I see the AI angle. I get it. But you can't just gloss over the bar on the left of this chart. It's in the red. The main engine, Semiconductor Systems, still saw its revenue fall by 8% year over year. That's a pretty significant drop for their biggest business. To me, that feels like a crack in the foundation. You're right to point that out, and that is a valid concern. But this chart perfectly illustrates the other side of the story. Take a look at the second bar, on the right, Applied Global Services, or AGS. It is absolutely soaring. This is their services, parts, and maintenance business. So while the big equipment sales were down, AGS revenue grew by a massive 15% year over year, hitting a record $1.56 billion. This is the part of the business that provides the steady, reliable strength. And this is a crucial structural point. The equipment business, Semiconductor Systems, it's naturally cyclical. It ebbs and flows with customer investment cycles. But the AGS business is completely different. It's a high-margin, recurring revenue stream. It's the classic razor and blades model. Every single machine AMAT sells creates a long-term service contract. This provides an incredibly stable ballast for the entire company. It smooths out all that cyclicality, and it's the hallmark of a mature, durable, and really well-structured enterprise. It reinforces the whole foundation. All right. I'll concede the services business looks solid, but let's talk about the bottom line. I'm looking at these earnings numbers, and I feel like I'm seeing two completely different stories. You've got this GAAP number and the non-GAAP number, and they are worlds apart. One is up 75%, which sounds absolutely incredible, and the other one is completely flat. What is going on here? How can both of those things be true? Let's solve this profitability puzzle. This is a fantastic question because it gets right to the heart of how Wall Street analyzes a company's core earning power. Think of GAAP over on the left as the official audited financial statements. It's the by-the-book number, and it came in at $2.54, a staggering 75% increase. Non-GAAP on the right is more like the street version. It's the number analysts use to get a better sense of core performance, and it was $2.38, completely flat. The difference, as the slide shows, is that the non-GAAP number strips out what the company considers to be one-time or special items to give a cleaner view of ongoing operations. So let's see exactly what got stripped out. And here we go. This is the key reconciling item. The major difference between those two earnings figures was a massive $253 million charge related to a legal settlement with the U.S. Commerce Department. Now, Wall Street prefers the non-GAAP number in this case because analysts want to see if the company's core business of building and servicing equipment is growing, and a one-time legal charge doesn't tell them that. It's considered noise, not signal. And this adjustment is what makes the operating story look flat, while the official GAAP number, which was dragged down by this charge, looks far more volatile. But honestly, earnings can be manipulated with accounting adjustments. If you really want to find the true, unshakable strength of a company, you have to follow the cash. And this is where the AMAT story gets incredibly powerful. Look at this number, non-GAAP free cash flow. That's the cash generated from operations minus capital expenditures surged an incredible 91% year over year, hitting $1.04 billion for the quarter. This is not some accounting metric. This is cold, hard cash hitting the bank account. A 91% increase is a sign of a company that is an absolute cash-generating machine. $1 billion in free cash flow in one quarter is impressive. I'll give you that. But what are they doing with it? Is it just sitting on the balance sheet, or are they putting that strength to work for investors? They are not just hoarding that cash. They're putting it directly into the pockets of their investors. Take a look at this slide. This isn't some vague promise. It is a stated commitment. The company's capital allocation strategy is to return 80 to 100% of that free cash flow directly to shareholders. And they backed it up this quarter, returning a total of $702 million through $337 million in stock buybacks and $365 million in dividends. This is the ultimate sign of a confident and shareholder-friendly management team. Okay, the Q1 numbers are solid. The beat was clean, the DRAM story is strong, and that cash flow is undeniable. I will concede the foundation is stronger than I thought, but a 10% pop in the stock, that can't just be about one good quarter that's already in the rearview mirror. This has to be about the future. What are they telling the market is coming next? Exactly. Like we said at the beginning, the market trades on the future, and the guidance a company provides is the single most important piece of the entire puzzle. It's the blueprint they're handing to Wall Street, and AMAT's blueprint for the second quarter is what turned a solid report into an absolutely explosive one. Let's break this guidance down because the numbers here are really stunning. For the upcoming second quarter, Wall Street was expecting revenue of about $7.01 billion. Look at the midpoint of AMAT's guidance, $7.65 billion. That is not just a beat, that is a massive, landscape-altering beat of over $600 million. I mean, to put that into perspective, they're guiding for a sequential revenue increase of over 8%. For a company of this size, that's like turning a battleship on a dime. Now look at the earnings. The consensus was $2.28 per share. AMAT's guidance midpoint is $2.64. They didn't just beat it, they absolutely crushed it. This is the forward-looking signal that sent the stock into orbit. And this wasn't just a one-quarter forecast. The company's CEO, Gary Dickerson, put a bold stake in the ground for the entire year. This quote from the press release says it all. He expects the core semiconductor equipment business to grow over 20% this calendar year. He is telling the market that the AI-driven demand they are seeing is not some temporary blip. It is a powerful, sustained tailwind that will drive significant growth for the foreseeable future. He's laying out a blueprint for a skyscraper, not a single-story building. All right, we have stress-tested this report. We've seen a solid beat on earnings, a powerful shift to AI-driven demand, and a really stunning forecast for the future. The bull case seems pretty clear. But before we deliver the iron financial verdict, let's hear the other side of the story. I'm turning to you. What are the risks? What are the cracks in this armor that we need to be aware of? The bull case is powerful, and it rests on a very solid foundation. Let's just frame it as a series of questions. Is there undeniable evidence of AI-driven demand? Yes, you see it in the record DRAM and services revenue. Is the forward guidance strong? It is exceptional, signaling powerful momentum. Is the company a cash-generating fortress? Absolutely, with free cash flow up 91%. And are they rewarding shareholders with that cash? Yes, nearly $750 million in one quarter. The structure looks very sound. But let's not get carried away here. There are some very real cracks in this armor that investors ignore at their own peril. First and foremost is China. Their own documents show that 30% of their total revenue comes from China. That is a huge red flag. A 30% exposure to a single geopolitically sensitive region is a massive risk concentration. One tweet from the White House or Beijing, one new export regulation, and a third of their business could be in jeopardy overnight. Second, just look at the stocks on history. This company has a well-known pattern of selling off after strong reports. The good news gets priced in so fast that it becomes a sell the news event where traders take profits and leave long-term holders holding the bag. And third, while you celebrate the cash flow, you're ignoring the GAAP operating margin, which fell significantly from over 30% down to 26%. That indicates real pressure on their profitability. The path forward is not a straight line up. There are serious geopolitical and execution risks to consider. So we come to our final verdict. After putting the numbers through the iron financial stress test, our conclusion is this. While the risks, particularly the China concentration, are real and they absolutely require vigilance, the fundamentals are exceptionally strong. The initial paradox of falling revenue and a rising stock is explained by a powerful beat on expectations, which is being fueled by the AI revolution. The explosive cash flow, the record results in key segments, and the stunningly strong guidance all suggest that this is not just a house of cards. The foundation appears solid. The question for your portfolio is no longer about the company's strength, but about its valuation. The question you have to answer is this. Are you willing to pay a premium for a best-in-class company that's firing on all cylinders, or do you wait for a pullback that may never come?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.